an exciting announcement we're having here at 5-Star. But before we get into that, let's do some quick background. Our event and these webinars are all about giving you information that are unique to our home services industry. My name is Scott Abbott, one of the co-founders of 5-Star Painting and CEO of ProNexis. And our mission at ProNexis is to transform the customer experience in the home services industry through voice, chat, text, and online booking. Format is pretty straightforward. We're going to have Doug and I will have a conversation around some things that are really interesting around what's happening in the home services industry around deals and deal making. At the end of that interview, it'll be open up to all of you to ask any questions you'd like. You'll note that we are live on YouTube, and so you can, if you've got any questions at any point in time, go ahead and post those questions in the comments area, and then I'll get to those at the very end of our interview. And just a housekeeping item on some events coming up here. So January 6th, we'll have Jeff Duden on from Duden Group. He's one of the founders of AdvantaClean and is very active in franchising, a great businessman, and he'll be talking about what he's up to and how you can grow your home service brand through some knowledge he's had over the years. So let me go ahead and do an introduction of Doug Kennealey from the Princeton Equity Group. Doug co-leads its investment activities and sits on the firm's investment committee. Prior to co-founding Princeton, Doug spent nearly 20 years as a private equity investor at Summit Partners, Silver Lake, Brazos, and MPK Equity Partners, which he co-founded in 2015. In addition, Doug has been a senior advisor at Princeton Ventures, the predecessor firm to Princeton Equity Group, since its inception in 2006. And Doug currently sits on the boards of Card My Yard, Strickland Brothers, Urban Air, Radiance Holdings, which is the parent company of Solo Salon Studios and Woodhouse Day Spa, and Stellar Brands, the parent company of Restoration One, Blue Frog Plumbing, and Drain, the driveway company, and Soft Rock, that's Gary Finley's business. His previous board and investment experience includes European Wax Center, which was acquired by General Atlantic, and Vision Source, acquired by Essilor, and Small Source. Doug holds a BA in theology and economics from Boston College and an MBA from Harvard Business School. Doug, welcome to the show.
Thanks, Scott. Great to be here.
Yeah, so the big announcement that we're excited to let you all hear about and know about is, late last year, we started engaging with Princeton Equity Group around an acquisition of 5-Star Franchising, which is my franchising business. We at 5-Star owned two brands, Bath Solutions, which does bathroom remodeling, and then Joe Homebuyer, which is in the real estate space. And we had just really big aspirations on growing something that would be very significant and lasting. And Princeton Equity Group was looking actively for a partner in the home services space that we could grow together. And so Princeton formalized their investment in our business in June. We went on then in July to acquire Gotcha Covered, which is a blinds and window coverings brand. And that really excited to do that deal. We'll talk about that a little bit. Paul Lindenberg is the brand president there. And we'll just kind of discuss, what made Paul decide to partner with 5-Star. And then a month later, we announced the acquisition of Bio1, which concluded in late August, which is one of the largest. It is the largest player in the restoration space on biological matter. And really excited about that deal. We are actively acquiring and doing deals in the home services space as we speak. And so with all that, Doug, tell us what got your attention in the home services industry, why you interested in the business, and some of your background.
Yeah, so our firm, as you said, Princeton Equity Group, based in Princeton, New Jersey, and Dallas, Texas, which is where I am. We've got about 15 people, including mostly investment folks, as is the case in most private equity funds, and then two operating partners. One is a guy named Dave Crisali, who is the longtime CEO of Massage Envy, and the other is Brandon Hare, who was the led franchise development efforts at Neighborly for the last kind of 9 or 10 years. And those folks kind of go hand in hand with us on the investment team to really help, businesses grow and scale across a variety of different areas of the business: operations, development, marketing, coaching, et cetera. So my partner and I, Jim Waskovich, who kind of runs the Princeton office, and I run the Dallas office, we've known each other for a very long time, 20 years. We are super close friends, and along the way have done a number of franchisor investments together. And we launched Princeton Equity Group in kind of late 2019, early 2020. We raised a $350 million private equity fund, so all committed capital, and we have full discretion over that capital, really with the focus on investing in franchisor brands. And so, with Princeton Equity Group, we have obviously 5-Star. We have a company called Card My Yard, which is a kind of a celebratory yard greeting rental business. Another business called Strickland Brothers, which is a quick lube oil change company, franchisor and corporate owned. And another business that we just closed on in the fitness space called D1. So I have 4 platform companies at Princeton, and excited to keep it going with 5-Star and keep adding brands. So that's who we are in a nutshell.
So love it. Doug, what got you really interested in home services? Why do you think that was an industry you wanted to pick amongst the franchise? Because obviously you're in fitness now, you're in automotive. What attracted you to home services?
Well, no secret. It's an attractive space for a lot of different investment firms, and I think we're drawn to it for a lot of those same reasons. It's a highly fragmented market. It's a market that we love to be around sectors of the economy that lack professionalization, and that is home services. And if you think about whether it's HVAC, whether it's window coverings, whether it's what Bio1 does, et cetera, there are thousands and thousands of sort of mom and pops that do these types of things. But when you are part of a franchise system, you have support, you have a corporate parent, you have a business plan, and often those franchise systems in the exact same industry as the mom and pops tend to outperform them. And so bringing that professionalization, is key. We look for businesses that have some sort of resistance in a recession. And home services, has that. I think there's macro trends in, do it for me and outsourcing these types of services. And there's also a lot of specialization going on. That's another macro trend within home services. There are now businesses that will pick up, dog doo-doo on your lawn, right? I mean, that business didn't exist a few years ago. And so it's being segmented. We saw the same thing in personal care and the spa business, right? You have the spa and personal care industry is being broken up into individual, services that were once offered by a collective, one-stop shop, right? You can go to a spa. You now have Massage Envy for massage, European Wax Center for waxing. You can go to a hair bar, dry bar for blowouts. You can go to an eyelash place. You can go to a makeup place. Yeah. So we're seeing that in home services, and I think the consumer wants that specialization, and so we're drawn to that. It's also a massive industry. It's just a very large industry. So all similar reasons. I think where we're not alone in that regard, but it's a great space.
I think all of us who are in the home services industry have seen what you just mentioned. I think which is why I love the business. Consumers in general are becoming less and less capable at just fixing their own home, right? And so they're looking for partners that can take care of that for them, make it really easy for them. And I love the fact there are in the home services categories new concepts popping up. Like there's a business that'll just take out your trash for you, not pick up your trash. They'll just move your garbage from your apartment block out to the curb so that someone can come and pick it up for you. That small movement is being taken care of by a whole business at this point. Yeah.
And if you to that point, I mean, you think about what, our sort of fathers and grandfathers did around the house versus what, we all do around the house, and probably our children, unfortunately, are going to do around the house. It's an outsourced trend. The trend is to outsource all these things and become more specialized. So
life's getting easier and easier. Yeah. I'm sure my grandfather probably is rolling over in his grave. He's definitely one to do all that stuff himself for sure. Yeah. I want to talk about, as part of this, as Princeton Equity Group looks at acquiring a home service brand, clearly there are some brands you're more interested in than others. What are some of the attributes you expect? If our listeners, many of them are founders or CEOs of a brand, what are you looking for in a brand like that? And do you expect the founder or the entrepreneur to stick around, or are you expecting them to move out of the business afterwards? Maybe speak to that as well.
Yeah. So maybe I'll hit the second part first around the founder and transition and things like that. So often there are two reasons why, and I would say this is the case for Princeton, all of Princeton's acquisitions or investments or partnerships in home services is no different. Two main reasons. One is they want some liquidity, right? They've built the business. It's their baby. They have virtually all of their net worth tied up in the company. They want to monetize some or all of that. The second is they realize they have something special. They're growing well. It's not a broken business, but they have the self-awareness to recognize that, I may need a partner to help me take something good and make it great. And that's sort of those two things merging is often the catalyst for a transaction with us. And in some cases, with founders or owners, often the founder is the owner or the majority owner. They want to stick around. They want to have that partner. They want to get some liquidity. They know that a group like ours, 5-Star or Princeton, is going to want to have a controlling interest in the business. Not because we think we know their business better than they do, but because often private equity funds are set up that way. It's a fail safe in case things really go off the rails. So they will often stick around, have meaningful equity in the business going forward. And we can talk more about that, sort of what's the, how does that look, and some of the specifics with the transition and folks that want to stick around or folks that want to transition out. But that's the catalyst for getting a transaction done.
Right.
In terms of your first question, Scott, around what do we look for in a business? I would say, we tend to be relatively picky. As a firm, we will close just a few transactions a year. We have our pulse in all areas of franchising. We track a lot of data. We scrape Yelp and Twitter. We go to trade shows virtually. We have some technology kind of process at Princeton that helps us do that. But first and foremost, I would say strong unit economics. So that investment, what we're doing at the franchisor level is really no different than what the franchisee is doing at their level, right? Mm-hmm. They're doing their due diligence. They are writing a check. They are getting a loan. They have to figure out what's the return on my investment. How easy is this to scale? What's the competition look like? They're sort of a mini private equity fund, and they're asking the same questions. It may not be as institutionalized as the way we would do it, but they're asking some of the same questions. And so our position in all of franchising is that if it's a micro business, it is not a macro business. It has to work at the micro unit level. It has to offer a very strong return on that investment for the franchisee. It has to offer strong cash flow dynamics and a payback period, things like that. So first is that unit economics. We do look for businesses that have, we call it kind of manageable recession risk. There's few businesses that are truly recession proof. Segments within the restoration space, segments within the HVAC space, sort of are the obvious ones. But where it's a manageable recession risk, we're growth focused investors, so growth is a key one. Good organic growth, and related to that, though, we like to see enough headroom or white space in the market where after a few years, the business can still maybe double or triple. And we'll talk a little bit more about that around what should, if someone like a founder or owner of a franchisor brand is thinking of transacting, what should they have in their mind? And I'll maybe touch on that in a little bit, but growth is a big one for us. Validation is huge. Look, everyone knows franchisees can be a difficult bunch. There's always the bad apples or the problem children, but by and large, we look for brands that have happy franchisees, that feel supported, that trust the CEO and they trust the direction of the business, and they feel like what they were promised was delivered. So we spent a lot of time, talking to franchisees and just asking questions that they did on their validation calls, frankly.
Yeah.
We look for businesses that are market leaders or category creators if we can find them. Bio1's a great example. It's the largest company in the industry that does sort of that biohazard cleanup. And we also look for ways or opportunities where we can really add value collectively, where we think our skills match the needs of the business to drive incremental value. So those are some of the thoughts.
That's great. I'd love to maybe just dive in a little bit on maybe a bit of a case study where we, on the Bio1 deal, in that instance, Nick Anthony, the founder, he was looking to move on. He built a great business over the years.
Mm-hmm.
He wanted to move on to something different. Maybe just talk to how that changed. How did you view that? And is it okay for a founder to, effectively say, I'm just looking to transition out and be gone right away? And does that change how you view the diligence on the business?
Yeah, So Bio1 was a great example of that. The founder and owner of the business did want to transition out, and I think he did a great job of building the business to where it was. He had a team, and he had one or two people in particular who were effectively running the business on a day-to-day basis. He had not been involved day-to-day for a few years, so we had that as kind of a nice fact in the transaction.
Mm-hmm.
That we weren't stepping into a situation where, we needed to sort of bring in someone to run it day one. We often don't come across that. It's possible, but more often than not, if that founder or owner wants to take a step away, even if they've been day to day up until yesterday, there's often one or two people in the business that, can really kind of take over or mind the store. And if we do need to sort of bring in that leader, often the founder is pretty supportive of that. So what we do, though, just to ensure a smooth transition, is we have a period of time. It can vary. It's sort of 3 months to 9 months, maybe, where that founder sort of said, "Look, I want to transition out. I'll help you with the transition." We put in place an agreement where we pay that founder, essentially a salary as a consultant to help us kind of take the training wheels off as we move from owner to owner here. And we care a lot about, as does the founder often, because the founder is the one who knows every franchisee. Most of the time, they have the cell phone numbers of all the franchisees, ensuring that the franchisee base feels very comfortable, understands the genesis for the transaction, understands that, if there are any kind of changes, they will often be positive changes. We're a firm, and I know obviously with you, Scott, we're not a group that, invests in a business and then just, cuts expenses and bleeds it dry. We're the opposite. We are investing more into the business. We are hiring additional talent. We are, investing in marketing, investing in, franchisee coaching, LMS tools, whatever it might be, to support those franchisees. Because our view as investors is that if you have happy and healthy franchisees, you have a pretty healthy and valuable franchisor. So we ensure that if there's a founder transition out of the business, that we really make sure that the franchisees are sort of taken care of, and we manage the messaging of that pretty tightly.
And so maybe that's great. Maybe as an example of something that's maybe even opposite to that, right? We had a situation with Gotcha Covered where the founder, Vic, was looking to retire. Paul, who was leading the business as a brand president, he still wants to keep going. He wants to be part of the growth story. And then how we approach that deal was a little bit different than how we approached Anthony's deal. Maybe speak to that a little bit.
Yeah, right. So Gotcha Covered was a bit of a hybrid, right? You had two folks who had been in the business for a very long time. Vic was the founder, but Paul had been sort of his right-hand man for many, many years, was the CEO and brand president. Vic wanted to exit. Again, fortunate that, Paul, who's just an A+ executive, had been running the business for several years. And so we were able to structure the deal where Vic was able to exit 100% of his holdings. Paul was able to take, some solid liquidity and some cash out of the business, but roll a big stake into the platform, the NewCo, kind of the holding company, and maintain his position, maintain the same team. In that deal, Vic ran development, but to their credit, they added some additional resources underneath Vic on development. So again, we weren't sort of starting day one without any kind of development apparatus. And much like the Bio1 transaction, Vic, who's a great guy, has agreed to stay on and transition, transition his role over the next, several months. And so it worked out really well. Everybody sort of got what they wanted in that transaction.
Yeah.
And I think, we've been around, this enough to know that every single transaction is different. You're dealing with oftentimes family businesses. You're dealing with a few different shareholders. You're dealing with partnership. It's tricky. And so we try to be very flexible and in the structuring and get people what they want. So.
Yeah, and I think you mentioned something that's important. That is this opportunity for a founder or entrepreneur to stay engaged, and to have an opportunity to roll in and be part of that growth story. Clearly, Princeton only invests in business they think they can grow, right? And so to be a part of that, where you've got a group of very intelligent professionals helping grow businesses, I know for myself personally has been a great help. I'd love maybe for you to talk about some of the things you wish that, going into deals that founders knew before they entered the process. Are there certain things that, for someone who's going their very first time through selling a company, what do you wish they knew before they entered that process?
Yeah. It can be pretty daunting. I think if, I have, family members that are entrepreneurs, and having been around entrepreneurs pretty much my entire professional career, it's a big decision. It's a very intensely personal decision. In franchising, you don't just have customers that come in and, buy your widget, and then you're off. I mean, your customers as a franchisor and as a founder, particularly at the beginning, were franchisees who have spent, in some cases, their entire life savings on the business, and they've backed you as the founder to try to, change their lives, really. So it's a very, very intensely personal and interconnected industry, which can make the decision to take on a partner, to sell 60% of your business or 100% of your business, a difficult one, and not just a monetary one. Mm-hmm. And that's the other thing I will say, that just having been around franchising is that the culture really matters. So I think first thing I would say is it's okay for it to be a difficult decision. It should be a difficult decision. It should be something that you feel really good about. But I would say, one thing to think about is to recognize your own limitations. Very few of the best companies sort of go it alone. And often they have help. The quickest way to get into trouble as a franchisor brand, particularly a high growth brand, if you're adding 20, 50, 100 locations or franchise territories per year, you're going to wake up in 2 or 3 years and have not 50, but 350 territories, maybe 250 franchisees. That is a completely different business. And if they are not supported, if you're not investing in the business, that's the quickest way to kill validation and to erode the value that you've worked so hard to create. That's probably one. I think the other is the time to transact is from a position of strength. When growth is really good, we often hear, well, if I just wait another year, my business is going to be, my EBITDA is going to go from X to Y, and I'm going to get more money from my business. I know I want to transact at some point. You can sort of always make that mathematical argument forever, right? I mean, businesses are hopefully going to continue to grow, but folks like us, I think, really do value the growth and pay for growth. And so you want to be in a position where you are sort of, transacting on that upswing
Yeah.
when there's plenty of headroom and white space in the market, like I talked about earlier.
Yeah.
If you're a brand that has maximum of 400 territories in the United States, if that's what you believe, and you're sitting here at 75 or 100, you're leaving a lot of growth, and folks like us and Five Star, pay for that growth, versus if you're sitting here at 350 or 375, yes, you're a bigger business, but what does that look like for the next 5 or 10 years? So I would say another, time to transact is from a position of strength. The other thing I would tell a founder or owner before they transact is capital is the easy thing to find, particularly if you are sticking around and rolling into the new business and going to maintain, be a CEO. But even if you're not, and you've built this business and you want it in the hands, you want your franchisees to be in the hands of people that know what they're doing, that are good people. You want your corporate team to be, around good people. I mean, capital is the easy thing to find. Fit really matters. Not all private equity funds are created equal. Not all, home services platforms are created equal. So what I would say is I would encourage the founder, the owner, the decision maker to do their due diligence, to know who are they getting into bed with. That matters a lot. Maybe one other thing, Scott, is, and this, the diligence process is robust for folks like us and Five Star and others. I mean, it takes some time. We really want to understand the business. And so be prepared for that. It's going to be the case if you sell your business tomorrow or you sell your business in 5 years. Don't be scared off by that. I think one of the things that we've learned on our side, certainly partnering with you, is that all we do is invest in franchise brands. Like as a private equity fund at Princeton, that is what we do. We don't invest in a widget manufacturer or a software company. We do founder-owned franchising all day, every day. And so we know what to ask. We don't try to ask for additional information that doesn't really matter. We sort of have our core things. We focus on them, and we can work pretty quickly. But the diligence process, it takes some time, and it's robust. So those are some of the things I'd want to know if I were thinking of transacting.
Yeah, great pointers. And I want to just double click on something you mentioned there, which I've actually seen, and it actually is quite intuitive. There's no question there are founders out there with businesses that are growing and are very successful today. And like you said, they ask the question, well, if I just waited one more year, and I've actually seen it where you've got older brands, they're in a saturated market, they've been around for 20 plus years, they've got great earnings, like their profitability is there, but they just aren't going to get the multiples that you would get if you had a brand that's growing aggressively. And so there's no question, if you're sitting on a brand that has a lot of growth story to it, it's a good time to be talking with Princeton. Let me maybe talk about how Princeton adds value. When you do get involved with a business and you've got a few brands you've acquired or you've been a part of now already, where do you see Princeton adding the most value to those brands, and how does Princeton, do that with the founders, the entrepreneurs running the business?
Yeah, so I think you're right. We've been around as a firm. We've been around, I think, 17 franchisor brands, and really including some of the largest, most successful, franchise brands in the country. And so I think one of the benefits we bring and the value add we bring is that we've sort of seen the movie before, where we've seen and helped these businesses go from, the second or third inning to scale, to go from 50 or 75 units to 300 or 1,000 in the case of Massage Envy. So we've seen it before. And I think as I said earlier, we're also a specialist. Lots of private equity funds have made 1 or 2 investments in franchise brands. In many cases, restaurants. We don't invest in restaurants. That's the one area of franchising we don't touch. So we're services-based franchising all day, every day. And so there just comes with that in and of itself is valuable. It's a valuable perspective. But we do, what we see a lot of is where you have a few people at the top of an organization and they really need sort of some of that bench strength. So we help the team, we help build out the team. And we have a pretty deep Rolodex, to help do that. There's also, several areas where brands tend to get stuck. I think the most notable one is on development. Franchise development is tricky. It is a big, if not the biggest driver of value, but there are many brands that stall out and just can't crack the code to get maybe over 100 locations. I think the average in our prior lives and at Princeton, I think the average location we've been around has added 75 new locations per year. That's the average. Some have been higher, some have been lower. We also, as I mentioned, have some folks on our team who specialize in development. I mentioned Brandon Hare, who ran development at Neighborly for many years. He's as good as it gets from that perspective. And so we kind of bring in some of those resources to work hand in hand with that CEO and founder to grow their business. I think on coaching, franchisee coaching, onboarding, franchisee relationships, marketing support. We've all been around businesses that have struggled in some of those areas, and we feel like we can really help. The other thing too is just we're sort of data people and KPI, key performance indicator folks, and so what we do post closing is help create a dashboard of KPIs where that CEO, founder, and some of the management team level folks can really look at on a daily basis or weekly basis. And I think one thing you find is we're often told, gosh, I never really looked at my business that way. I sort of thought I knew my business, I knew it, but I didn't really see all the data kind of lined up, sliced and diced. And it really creates a lot of insight into the business that can help those managers manage the business better. So I think we're pretty good at that, pretty good at taking a business, dissecting it, and kind of simplifying it and helping the management team use that information to run the business better. And then also I just want to say on the financial piece, oftentimes businesses don't have a chief financial officer. They may not even have a controller when we get involved. But we do invest heavily in that, in those types of roles, because again, without that data, it's hard to know what to manage if you don't know what you have.
I know from personal experience, since our deal was done earlier this year, the value that Princeton's brought to us has been incredible as we've gone through monthly reporting, KPIs, and solidifying what those are, looking at data in a way that helps us really, manage to it. It's been incredible. And I think one of the things I have seen is, in general, most entrepreneurs tend to be really good at sales, right? Mm-hmm. It's how they got the business started, and they can convince someone to buy a franchise when you only have one location. Or they're really good at marketing to get that brand out there, right? Great at PR. They're great at those elements or the operations of the business. But I often do see among early stage franchisors and businesses in general that they aren't investing as aggressively around the financials, the accounting, the bookkeeping. But yet, as you mentioned, like that stuff's so important to understand, which kind of transitions me to the next point. As you're looking at deals and you're considering buying a company, I'm sure you've seen this happen often. What are the things that get in the way most frequently for a founder to make a deal happen? Like when you get in there, you're doing the diligence and you're going through all that data. What are you finding is the biggest challenge that gets in the way of a deal?
I think in some cases, I could talk about what maybe the diligence that we would find or uncover that gets in the way, in addition to just the decision to transact. I think the decision to transact is now the right time. Now versus later is probably the biggest one. I think what we have found, and I not to sound arrogant or self-serving, but if the decision is I want to transact, what we have found is folks sort of buy into us as a partner, right? They recognize that franchising is specialized, it's idiosyncratic, and they want a partner that really, really understands their business. And so that's back to the question of what should somebody know? Know who your partner is. I mean, make sure they understand your business and franchising. And so that's a big one. I think certainly valuation. Just the economic terms can get in the way of a transaction. In terms of the the due diligence and what sometimes would make us press pause. We want to be around people who, are ethical and have good reputations. So life is just too short. So I think some of that sort of that softer kind of subjective stuff, as it relates to background checks or just demeanor, bedside manner, how they treat their team, we can meet with the business and just say, this doesn't really fit with us. I don't know if I could work with this person. I know that sounds so basic, but it's really true. I think the other thing too is what we have seen is franchise brands in their infancy can really give away the store when it comes to territory size. I would be very, very careful. It's very easy, and it's very easy to get sucked into this early on. You want the franchise fee, you want to grow, and you give somebody the entire state of Texas, one person, and that's going to come back to bite you later on. And so one of the things we look at is, how big are the territories? What's really out there, back to the white space question. So that's sometimes where the diligence where things can kind of fall down a bit. If we just feel like, gosh, now we'd have to go back and kind of cut territories up and to really be able to grow the business. And then I think validation is another one. You do enough of these calls and you know what people don't say. People are very careful to not say derogatory things about a CEO or a founder or a brand, but you can kind of tell if they're just not really, really enthused about the business, if they don't want to buy another territory, if they had the means to do it. That can be a major red flag for us.
I know from my experience, one of the things that I would share with all our listeners is that often a franchise brand there's things they know they should do, like, for example, enact an ad fund or raise the ad fund from 1% to 2%, or make sure there's a technology fee, or deal with some of the economics in the franchise system that they know should happen, but they'll put off and wait till after a deal's done because they don't want to ruffle feathers or upset anybody. But when you think about it from our perspective, after you acquire a company, the last thing you want to do is come in and have all the franchisees go, oh, great, now we're dealing with a new owner, and that new owner wants to make us pay for a lot of things that we weren't paying for before. And the best time to do it is, if you're thinking of selling, is now. If it's right for the business, do what's right for the business. Don't wait for some event around a transaction to do it.
Right.
So I know that is something that's to consider. Maybe let's talk about some more macro things that are happening in the marketplace right now. There's no question, in my lifetime of 17 years in home service franchising, there's never been as many people interested in buying a franchisor in home services. So I'd say that it's a little frothy. I think there's the word that people use to describe the market. What are your feelings on that? Are you worried that maybe it's getting a little overheated and that expectations are getting out of whack at this point? Or what are your thoughts on that in general?
Yeah, I think we would agree that it is pretty frothy. It is a seller's market, unfortunately not a buyer's market here. You have interest rates are at essentially zero. I mean, they're at record lows effectively. You have record amounts of capital sort of on the sidelines to be deployed. Private equity capital that's been raised and ready to be invested. The debt markets, banks and other sort of private credit lenders are sitting on more capital than they've ever sat on before. You have inflation, which is in the news. That's sort of heating up a bit, certainly in home services. And so it's ripe for pretty high valuations on businesses. And it's hard to, obviously no one knows the future, but the party does not continue forever. It will subside a bit. So we're careful on our side, but there are some unrealistic expectations out there for sure. People have seen multiples paid for the Neighborlies of the world, and say, gosh, I'm in that space, and I think my business is worth that much. So it's pretty frothy, and I think people are now, over the last several years, have sort of caught on to this trend in some of these businesses that weren't sort of as sexy, like think of HVAC. But when you sort of peel back the onion, you sort of say, gosh, these are really nice businesses. They're not going to go away. People need air conditioning and heating. And so it's a safe place to park money in this world, right? I mean, you may not as an investor, make 5 times your money, but you're unlikely to lose money. And so that's a pretty attractive place to be. And so hence valuations are pretty high. They are.
So maybe just for fun, I mean, I did an undergrad in finance and an MBA as well in this category. So I always have fun talking about it, but like some financial theory for all of our listeners that maybe have never looked at, why does interest rate affect the value of my company and so forth? Maybe could you just kind of speak to why inflation is important and why that would impact the valuation of a company? And then if the Feds are going to raise interest rates to combat inflation, which there's a lot of talk about that.
Yeah.
How does that impact the value of a business?
Yeah. So it's really no different from, the easy example is maybe the home price, value of your home, right? If we're an investor looking to buy a business, we're going to use our own equity and debt from a bank. And then we are going to say, okay, what is this business how's this business going to perform over the next 5 years? And maybe we would exit in year 5. But the cheaper the debt, the lower the interest rate on the debt, the more we can pay for the business. Just like, you think about, I want to buy a $500,000 home. Well, and interest rates on the mortgages are, instead of 5%, they're 2%. Well, maybe I can afford a $600,000 home because my monthly payment on my mortgage is, going to be, $1,200, not $1,500. It's the same thing in sort of the private equity world. And so you're seeing that. In addition, you're seeing lenders, and typically this is just a rough number, but typically you buy a company for $10 million, it's typically half and half, and this is very generic, just sort of private equity 101, but 5 million of equity and 5 million of debt. In addition to low interest rates, though, what is in this environment, what is making or allowing investors and private equity funds to be able to pay more is not only do you have a low interest rate, but these lenders in today's market are saying, well, I'll give you a loan for that $5 million and you don't have to pay back any principal until year 5. I mean, many loans in this market, particularly with a good private equity fund alongside that lender, are essentially interest-only loans, or maybe the loan amortizes 1% per year. That lender has really loose covenants, which are basically financial metrics that the company has to meet to not get in trouble with the bank. Banks are loosening up those covenants. So that is also leading to these higher kind of asset prices. And it's also just supply and demand, as I said earlier. I mean, there's a finite amount of businesses in the country, and you just that's the supply, and the demand is all the capital, all the investment firms, all the lenders that are trying to buy those businesses or invest in those businesses. So there's a supply and demand imbalance as well, which, is economics. And so higher demand and sort of fixed supply means higher pricing.
So when you print $7 trillion, that's what happens.
Yeah. Well, and then back here, you sort of alluded to inflation, right? I mean, I think everybody who runs a home services business today has seen inflation, whether it's literally from materials or from the fact that labor is more expensive and therefore I need to raise my prices to maintain my margin. However, which way you come at it, pricing has gone up, and so you have even higher growth rates on the revenue side, which makes folks like us more interested. So,
yeah. So at this point, if anyone has any questions, feel free to put those in the comment section on the YouTube channel. I'll be happy to ask those questions of Doug for you all to hear. In the meantime, I've got a couple more questions while we wait for that for you, Doug. What have you seen over the years of deal making, 17 years of deal making? How have you seen terms change in the agreements that are being signed today versus what they were, 10 or 15 years ago?
Yeah, so I think probably the biggest change or evolution has been in what's called representation and warranty insurance. So, 10 years ago, when you sell your business, you have a contract, buyer and seller. It's called a purchase agreement. The seller makes representations, sort of statements that say, I own the business. I promise you that, the financials I've given you are true. I'm complying with franchise laws, et cetera, et cetera. And if it turns out that some of those are false, the buyer can come after the seller and say, hey, you lied to me and I want some of my money back. And that seller would have an escrow put aside, maybe 5-10% of the purchase price, that's kept aside for a year or two to cover any of those claims that the buyer may make. What's happening now, and this is not a new thing, but it's over the last several years, for transactions above a certain size, the escrow amount is essentially zero. And what happens is the buyer and the seller go out to an insurance company, and we set this up. It's very, very common. I think probably 90% of private equity transactions above a certain size have this rep and warranty insurance, where the buyer and seller go out and they get an insurance policy. And typically the premium is split. And the insurer kind of takes all the due diligence reports and all the analysis that we've done as the buyer. They look at it and say, yep, I'm going to be the one where, buyer, if you have an issue with these representations, don't go after the seller. You come after us and we fight about it. And so that's a win-win all the way around. Actually, it's great for the seller because the seller doesn't have to have, let's say, 10% of their purchase price sitting in a bank account for a year and a half or 2 years and not in their own bank account, right? There's essentially no escrow. So the seller gets all their proceeds and they don't have to fight with the new investor if there's an issue. That can create problems, right? I mean, if we're partners and I think you have, lied or misrepresented something, it just gets awkward. And so now the buyer is fighting with that insurance company. The benefit to the buyer is that, in addition to those benefits, is that you can often get stronger representations than you would be able to get if the founder or owners or sellers were standing behind all of those representations. So the bar is essentially lower for there to be an issue, and then I would fight about it with the insurance company. So that's probably the biggest change over the last several years, which has been a great positive change, and it's now kind of widely adopted.
Awesome. So. Great. Thanks, Doug. I've got 3 questions here I want to pull from our attendees. So first we'll go to Matt Kelton. Matt, good to see you. Thanks for joining us. His question is there a minimum EBITDA number you're looking at when considering an acquisition?
So I would say on the Princeton side, it's typically, you can just put that, a few $1 million, I would say, on the low end. I would say for 5-star, it's definitely less than that. It's probably in the 6 figures, I would say, from an EBITDA perspective. But it can really vary. You can get businesses that maybe have a large sold but unopened pipeline that are just not quite at scale yet, but we sort of know, and Scott sort of could say, look, they're going to open up that backlog. They're going to get those territories open. And so we look, we're obviously investing in the future, not the past, but that's kind of a rough answer.
Yeah. Thanks, Doug. And thanks, Matt. Next question here from Terry O'Donnell. Terry, thanks for joining us. Do you consider other service brands, i.e. junk removal or moving services?
Yeah, I think for 5-star for sure. Yeah, we would look at junk removal, moving services as well. Yep, definitely.
Yeah, give me a call, Terry. Love to talk to you. David Hyduck, thanks for joining us. Dave, he's from Desk Rescue Franchising. In general, is there a target AUV that private equity firms want to see before considering a brand? For example, would a seasonal niche business ever be considered?
Yes, a seasonal niche business would definitely be considered for sure. There are businesses that are stronger in the summer, stronger in the winter. That's totally fine. We like to see not necessarily a target AUV, but the math that we like to do is the total cost to become a franchisee in a particular brand. And in home services, let's just say it's $100,000. Forget how you finance it. Forget if it's all your money or you go to an SBA lender. $100,000. What we like to see is that the return on that investment after 3 or 4 years, sort of close to maturity, you're up and running, what that franchisee can earn in profit, sort of pre-tax, pre-debt service, before paying themselves. We like to see that to be at least 50% if we can. In many cases in home services, it's 100% or it's 200%. But that's kind of how we look at it. And that's one of the reasons why, as I said, the very first thing we look at as investors are unit economics. These are micro businesses. So.
Yeah, and that really good point. And I think that you're seeing as well, Dave, is that you'll see some brands, like let's say in the deck business, will augment that brand with like Christmas lights or some other seasonal business to help create a full year-round approach to things. I know that we actually did Christmas lights at 5-Star Painting for a little while in an effort to help some of our northern franchisees. So it's something to consider. Austin Meek has a question for us. What is something you've changed your mind about recently?
Geez, that's a good one. Changed my mind about recently.
I've changed my mind about eating dairy. I don't know if that counts often or not, but
yeah. Well, I think I realized too much Halloween candy is actually a bad thing.
Yeah.
But no, I think I think maybe my thinking has evolved a little bit on the state of the market, as it relates to the macro environment. And I would say in the last 6 months, maybe felt like the party was going to continue for a really long time. I think sort of looking at the data, talking to people actually running businesses, I think we're going to look back at this time, the last 6 months, maybe the next 6 months, and realize that this was a incredibly unique time to be in this business, in our business, and that, not to get caught up in the frenzy and just to be, to continue to be disciplined. So I think my thinking's probably evolved on that a little bit over the last few months.
Yeah, there's no question that it can be easy to get pulled in, right? But and to start believing the hype, if you will. I do think that home service franchising, which is why we both love it, Doug, is somewhat insulated from some of that market hype that it does occur. Homeowners need to get work done. They're getting less and less adept at doing it themselves. So I think it's why we're investing in the industry. But there's no question that we want to be cautious and mindful of that. Another tough question, good answer. You're welcome, Austin. Happy to have you on the show. Corey Summerhays, good to see you. He's got a question here for us. Do you see that blockchain and smart contracts will be the most valuable and efficient way to handle warranties in the future? And blockchain and smart contract technology on your radar in franchising? That's a really good question, Corey. I don't know if Doug, any thoughts on that?
You're asking the wrong guy. I don't have a view on that, unfortunately.
Well, how much Bitcoin do you have, Doug? Maybe you can just kidding.
Yeah, I'm trying to figure out how to spell Bitcoin at this point. So I'm not on that one. Sorry.
Good question, though. I think to answer your question, Corey, I know that we are not looking at the blockchain presently in something we would incorporate for our businesses. It's so easy to do contracts with customers using an app that just sends it and they can sign digitally, and it's all, frankly, very seamless and simple. I feel like blockchain would complicate things because the adoption is not there yet for the average consumer where they can do that. There are some, bleeding edge, cutting edge type people who are using and accepting Bitcoin. I feel like often that's almost like a PR move to just get in some headlines and tell people you accept Bitcoin to buy a Tesla or whatever. And that all being said, I'm sure that, at some point in the next 15 or 20 years, we'll look back at this and say, well, we should have been investing in some aspect of using that technology to handle warranties. But I think that the jury's still out as to exactly how that's going to happen. So I've been waiting personally on implementing anything at 5-star. I got one last question for you here, Doug, that I wanted to ask you. If any of the listeners have a question, feel free to post them on the comments. In terms of how long it takes to get a deal done, from the moment you start the process, I know there's a courting period. You get to know the business. You do some diligence in general to make sure you like the business, and then the LOI or the letter of intent is signed at some point, which then kicks off a whole flurry of activity. How long from that moment of the LOI till a close occurs? What does that look like, and has that changed over the years?
So I think it has changed in the sense of, at least for us, again, we do sort of franchising all the time. I think we've been able to shrink that timeline. I think a good rule of thumb for us, which is, I think, very, very fast, is 45 to 60 days from signing the letter of intent. And as Scott said, you get to know the business, we get a little bit of information, understand, the growth plan, understand the business, understand the needs. What is the founder owners, what do they want? What are their goals for themselves personally, their goals for the business? How can we help? We come up with the structure and evaluation pretty quickly. There's pretty much 5 key pieces of information that we like to see. And with that, we can be sort of 90% confident that the valuation is going to stick, and then we'll close the transaction. And then we get to work, and we sort of do that confirmatory due diligence, and over the next 45 to 60 days. So
I know that so there's barely enough time to get a deal done this year. If you want to get a deal done, you've got roughly 11 days to sign an LOI before taxes come up here in January of next year. I know there's a lot of talk on that. I know it's creating a lot of interest in general. People are looking to, to take advantage of what they've been building over the years. And this might be that moment for you to consider it. So thank you, Doug, so much for joining us. It's great to be your partner now at 5-Star Franchising and to be working side by side with you in this industry. Thank you to our listeners for tuning in and your interest. If any of you have any questions you want to hit us up with, feel free to reach out. I know we'll probably send out a survey after this, just asking for some feedback from you on how the event went. And if you've got any feedback as to who you'd like to have on the show or the kind of questions you want to have asked, feel free to give that in your feedback. And so thank you.
All right. Bye-bye. Thanks.